In this week's update, sadly, the US election cannot be ignored. The ultimate success formula, it's not what you think. And gold maintains momentum. My name is Garry Davis. I'm an authorised representative of Primary Securities, and any advice is general advice only. Your personal objectives, financial situation, or needs have not been taken into consideration. All right, let's start with a market perspective. And this is not a bad time. There's a lot of uncertainty around. It hasn't really affected markets that much, but it doesn't mean that it won't. And with the US elections getting very, very close now, and the consequences of that being somewhat unpredictable, it's not a bad time to be just thinking about whether some sectors have run too far too fast, or whether some sectors have been left behind and are due for a re-rating. So just put the contrarian hat on. I think when things are going well, as they certainly have been, it's just time to have a little look over the railing, see what the crowd is doing, have a think about where consensus opinion is, and just look at it flip it over and have a look at it from the other side and ask the opposite question. Instead of what are the reasons that a certain sector or a certain stock might go up, but what are the factors that could push it the other way? There have been many stunning local trends. There really are, as many as I can recall. And part of the reason for that is because small caps were out of favour for so long. They lagged the large cap end of the market. And now they're having their day in the sun and they're getting lots and lots of support. And many of them are warranted. There's a very, very solid business case for why the share prices are re-rating upwards. But some of them are not. They're just going along for the ride, and they'll get found out when earnings season comes around. So you've still got to be very diligent in the way that you do your stock research. And just sticking with the contrarian theme, just consider these changes that have occurred over the last, let's say, 5 years. So if you go back 5 years, the energy transition was the talk of the town, and the consensus thinking was that it would change the world. And it really didn't appear that anything would get in the way of that. But commercial reality has set in, and some of the new technologies are just nowhere near being technically capable, but they're also not commercially capable unless governments just keep throwing oceans of money at them. So commercial reality has certainly slowed down the energy transition. And I think there's a lot of people now questioning whether the investment, the massive investment, and the interruption to standards of living that are going to be required to meet these targets, whether they're all worth it. I'm not making any comment on whether they are worth it or not. I'm just observing that the narrative has shifted. It's not seen as a complete no-brainer as it used to be. If you go back a similar time frame, the rise of electric vehicles was going to be an absolute no-brainer. And of course, to allow that to happen was the development of critical minerals, be it rare earths, be it graphite, nickel, copper, whatever it was. And yet here we are 3 or 4 years later, and all those areas are struggling, and lithium, of course, being the most obvious one, with a 80+% fall from peak to trough. And then we have green hydrogen. Green hydrogen, again, was another technology that was going to open up incredible new frontiers. And certainly in Australia, the companies that were supporting that and pursuing that have basically pulled back. And it's really only the government that's still waving the flag on green hydrogen. And it was also, if you go back a couple of years, when the interest rate cycle really started to turn up in earnest as inflation broke out post-COVID, the thinking in a lot of quarters was that this new cycle of rising interest rates after 4 decades of falling interest rates would crash the market. Well, that didn't happen either. The market has just continued to go up. And it's continued to go up whether interest rates went up or, in fact, have now rolled over and gone down. So it hasn't really affected the market that much at all. So I just think it's a good time just to sort of recheck, particularly the areas that are being most supported, the areas where, everyone is nodding and sort of agreeing that that is going to be the continuing or the next big thing. Okay. Now, just before I move on, it's really important that you obtain your own investment, financial, legal, or any other advice before taking action. It is easy to underperform in the stock market, which is part of the reason I do these videos. It is not that hard to lose money in the stock market. You've got to get this formula right, otherwise you can suffer loss of funds. Let's turn now to American stocks. The S&P fell 1% for the week, so that interrupted the 6 consecutive weeks of gains. The Nasdaq was slightly higher, but let's call it flat. We saw the equal weight S&P down about 2.1%, and also the Russell, so some selling in small caps, was down 3%. So that reversed what we've seen. Whether this is just nervousness leading into the US election or not is hard to tell. Earnings season has had its winners and losers, but it's playing out pretty much as you would expect. The number of stocks that are beating revenue and earnings targets are about where they normally are. The week coming is a huge week. We've got a lot of the major tech stocks reporting as well. So that has the potential to influence the index quite a bit. And then, of course, the election uncertainty about who will win. It's a very close run race. And then the consequences of whoever wins becomes a factor for markets. It's almost impossible to read. I'm not turning my mind to it at all because it runs the risk of planting a particular seed in your mind about, if this happens, then this will be the consequence. And I just think this is very, very unclear. So just keep an open mind. Just play the ball as it comes down the pitch, I think is the best advice. The US dollar moved a little bit higher to 104.3. The 10-year yield pretty much unchanged from last week, 4.25%. And the VIX is at 20. So that's sort of indicating a bit of nervousness probably around the US election. Let's go and check out some charts. So this is the S&P. We've got to go all the way back to the first week of September for the last time that the S&P finished down on a week. But you've just got to step back and look at that, and that trend is pretty powerful. So even if we got a pullback to, say, somewhere around here, which would be around about 300 points, we would still have a very strong trend on our hands. So if we do get a few hundred points of downside in the next month or two, then, don't think that things have changed because this is still a very, very strong trend. So the S&P has obviously hit new highs following the middle of July. But if we look at the Nasdaq, it has not quite surpassed, or it's about line ball with where we are in the middle of July. And that, of course, has been a bit of pressure on some of the larger tech stocks. Now, if we look at the individual sectors, finance had been doing really well, but did come off the boil. So this is over the last month. So finance backtracking a bit last week, and that is what was a drag on the S&P. Energy has done a little better, certainly in America, but not locally in Australia. But look, tech stocks they're still there. The more advanced or the more aggressive parts of the market, technology, communication services, and this is consumer discretionary, but heavily influenced by Tesla in that index. And Tesla, of course, had one of its biggest daily rises in many, many years. So I'm not getting terribly excited about that particular trend. But if you look at the rest, materials, consumer staples, and then healthcare, surprisingly, at the bottom of the pack. So this orientation is still very much that the more aggressive sectors of the market are still leading. If we look at Australia, information technology was the clear leader until a few weeks ago, and that's just so much about WiseTech Global. That's been a very, very public story. We had a bounce in that stock, which I'll talk about shortly, that bounced this index. I think it's important just to recognise where that company sits in terms of probabilities. Small caps came off the boil just a little bit. Materials, healthcare is not really shooting the lights out at the moment. And of course, at the bottom, as it has been for a long period of time, is the energy sector. And I'll also have more to say on that as well. The Nasdaq 100 is just line ball with the S&P. There's really no difference, and it's been pretty much in balance in terms of money flows since July of 2023. So 18 months where neither index has really been favoured by the money flows. Importantly, the semiconductors starting to pick up again now. There was a little bit of a wobble around ASML, but the other results that have come through for the likes of Taiwan Semiconductors and a couple of others have shown that the semiconductor market is not heading for disaster, at least not yet anyway. Okay, let's move on now to the Australian market. Our dollar was lower, 65.34. Our index fell 0.3% on the week, and the drag there was, of course, energy and IT. If we look at the gold sector in Australia, so GDX, the Australian version of GDX, going to 1.1%, it was doing a lot better than that, but did slip back on Friday as there was some profit taking in gold stocks. But as you'll see, the gold price just continued to march on Friday night. So we'll quite probably see that reversed on Monday. The Emerging Companies Index, XEC, has been in steady uptrend all year. So that's a real positive. And it goes back to what I spoke about at the open, and that is the recovery after many, many years of lagging of good quality small cap stocks. They really have had a very good year. And the winners in that area of small caps really span most sectors. There's plenty of great trends in whether it be technology or healthcare or resources or industrial. It's very, very stock specific. And I just want to look at, I think there's some very valuable lessons to be learned from what has happened with WiseTech Global in the last couple of weeks. So let's go and look at those charts. Just before I do, let's just have a look at the currency. There's the US dollar on a weekly chart. So we've now had 4 weeks of rebound off this important support to the upside, and that has pushed the Australian dollar down. And of course, gold up and the Australian dollar down has been fantastic for the Australian dollar gold price that we will get to. But if we go to the Emerging Companies Index, you can see that we've been moving up, setting higher highs and higher lows since October last year. So this is a weekly chart, and we're just trying to break out now. There's a couple of little points of resistance here that we've now been able to overcome them. So it's likely that this index will continue just steadily working its way to the upside. That's quite positive. There's the energy sector, still really struggling. Lower highs, lower lows. All of the moving averages, the shorter term moving averages have rolled over. The price is below all of them, and it's below the 200-day moving average. So this is a very ordinary situation for the energy sector. We've broken significant support here, rallied back to it, and now it's dropping away again. It's a sector that I find extremely difficult. Finance continuing to do well in Australia. Healthcare just sort of so-so in the middle. That's the information technology sector on a weekly chart. You can see there was a bit of a bounce, and I'll come to that in a minute. And there's the ASX 200. And finally, just rounding it off, there's materials. So let me go to this chart of WiseTech Global. You know, there's been plenty of recommendations from brokers to either sell or buy WiseTech Global. And I did get a question or two around this, that it raises the question about why would you want to? So I posed the question, is the future more or less certain than it was 2 to 3 weeks ago before this whole scandal around Richard White emerged? Now, WiseTech Global has been a fantastic wealth compounder for many, many years, more than a decade. And it was a stock that we did extremely well out of in the Insiders Club. So it's a stock that I was very favourably disposed to, and it pained me to have to step back from the stock. But you've just got to recognise that the circumstances had changed. So I posed the question, is the future more or less certain? And I think you'd have to say the future is less certain than it was. It's very unclear what happens from here. And it's not just what the company does, it's what the company's clients decide that they're going to do. So do you really want to guess on a 50-50 bet? Is there a need to buy back into a stock like WiseTech Global, as tremendous a performer as it was, or is it best just to go somewhere else because of that uncertainty? And if you look at the price action, it's really clouded the picture now. So the stock price had started to decline on the 17th of October. We then got a massive gap down on the 21st of October to a likely technical support level. We got a tiny little bounce. We then broke support, and it was really looking very, very ugly on Thursday. Now, Friday, we gapped up on the announcement that the CEO was stepping down, but he would be retained in a consulting sort of capacity. But after that huge gap up, the price pretty much traded down throughout the session and finished almost on its lows. Now, I really don't know whether this price is going to go up or down, and that's the point. You don't want to get into a mindset where you have to own a certain stock. You don't. If the future becomes uncertain, then just leave it alone. There are so many stocks out there that offer far greater probability that why would you try and play a guessing game on a stock like this? Just leave it be and let's see how things pan out and go and look somewhere else. So I think that it's a really important message that you don't have to own anything. So don't never get your heart set on owning a particular stock. If the probabilities are high and the upside is significant compared to the downside risk, then do it. If that formula, that balance changes, then just put it in the bottom drawer for a while. Just forget about it and just, keep a loose monitor on it. But don't ever get your heart set on owning any particular stock. It's just very, very misleading. Precious metals now, gold was up another $28 to $27.49. So gold is really motoring now. But if we look at it in the Australian dollar terms, because the Aussie dollar fell as well, we're up to 41.72. That is incredibly profitable territory. And that's why the Australian GDX had a pretty good week. If it wasn't for Friday, it would have had an outstanding week. Silver was flat, as we'll see, around 33 3/4. If we look globally, Newmont missed badly. And that's been a story of those mega majors that, the 3 or 4 or 5 major global gold stocks. They've really been struggling, Newmont and Barrick, for years. They've not been the outstanding investments. They've not been the market leaders. And the Newmont miss got absolutely punished. I think it was down something like 15%. So it's certainly not plain sailing despite this very, very buoyant gold price. But the stocks locally certainly have done much, much better. And of course, part of the reason for that is the Australian dollar gold price being up well above 4,000. And it's not just been the producers either. The producers have done well, but it's also been the developers, the better quality developers have done exceptionally well. All right, let's just go and look at those couple of charts. So we'll start with silver. There you can see it's a weekly chart. So we had a great breakout the week before and then just marking time during last week. But the US dollar gold price advanced again. So that's a very, very steep uptrend. So we had this lengthy consolidation between August of 2020 and March of 2024. So getting on towards 4 years of sideways movement between 1650 and roughly 2100. And now we've just burst away from that in March, and we've gone from under 2100 to 2750. So it's been a meteoric rise with just a relatively modest time of consolidation here. But in Australian dollars, we've had a couple of very good weeks now. This has really accelerated with our currency falling as well. So it's been very strong. And the fact that the US dollar is rising really adds more weight to the strength of this gold price, because there's been this currency drag, yet the price of gold has accelerated. So it really is extremely impressive. So if we go to GDX, really strong move on Thursday. On the week before. This is a weekly chart, big pardon. So the week ending the 18th of October was a very strong week, and it closed at all-time highs. In terms of closes, we had some intra-week highs up here. This was the highest weekly close. And then we were looking particularly good until Friday came around, when there was a bit of backtracking on Friday, but we may well see that turn back up again on Monday. Other commodities, copper and nickel. Copper was steady, nickel was down a bit. And that was really just a mixture of the US dollar going up and certainly the somber economic outlook, which is supported a bit by the oil price not being as buoyant as many would expect, given what's happening in the Middle East, is sort of weighing on those prices of base metals. Crude oil rises, pardon me, I should have deleted the word falls. So crude oil was up to $71, $78, $66 is a crucial support level. Anything below that, we could see a pretty quick $10 or so drop in the oil price. But look, my view, and I've expressed this many times over probably the last 5 years at least, is that I find investing in energy stocks in Australia is a very low probability exercise, and that's really borne out by what XEJ has done. It's by far the worst of the indices, and it's very difficult to get enthused about the energy market in Australia. Wrapping it up, I think it's really important, and this goes back to the start where I talked about the need to just put your contrarian hat on and just always have a look. Don't get caught doing the same old things month after month. Downplay the logic. Logical conclusions don't play out often enough for you not to rely on them. Do not rely on logical outcomes. And part of the reason for that, of course, is that generally what leads into a news event is generally already in the price. So that's part of the reason why logic doesn't tend to work out. But the important thing is to overweight the money flows, overweight what the chart patterns are telling you, because that's what's important. You make your money by the fact that prices go up or down, and you want to buy low and sell high. So that's the most important thing. The logical conclusion is not the most important thing. And I know that many people grapple with that concept because it just seems like it's fair that it should, but I can tell you that it doesn't. So put far more weight in what the money flows are telling you than in what you would think would be the logical outcome. Combine that with clear risk management. So if you're watching the charts and you've got a good, clear risk management plan, you know what signals an entry and you know what signals an exit, then just do that and you'll almost certainly get better results than any other approach to the market. You got to clear all the clutter from your brain. Question commonly held views, particularly when they become extremely commonly held, is the time when you really need to be looking somewhere else. Get rid of all the old wives' tales and all the relationships that supposedly were. The one that everyone's heard, and that is sell in May and go away. The stats just don't hold water on that one, yet many people get very nervous when May rolls around each year. You got to clear all that stuff out of your brain. Buyouts, truly outstanding assets. If you don't know how to identify what is a truly outstanding asset, a business that's going to continue to grow and produce and thrive for years and years to come, then get someone to help you with that. But there are so many truly outstanding assets that you don't need to look for maybes and possibilities. If you buy truly outstanding assets, it just sets you up for success, because then you don't have to worry about short-term fluctuations. Do I or don't I get out of this stock because the share price is going down in the short term? You can just largely ignore all that. But sometimes, if warranted, and WiseTech Global is a case in point, where the circumstances around that company have changed. Have they changed a little bit or a lot? I don't know. But the point is, it's now uncertain. So back out of it, do it promptly if it's warranted. And just on that point, it's really vital that you have very clear and unequivocal exit triggers. Exiting is the thing that people have told me over decades is the thing that they struggle with the most. And it's not that difficult. There are 3 triggers that I use, and they're extremely clear. There's no ifs, buts, or maybes. The box is either ticked or it's not ticked. So if warranted, do it properly. Portfolio analyst coming up this week, going to be looking at some strong local trends. There are many, many of them. Very exciting period. It just remains to be seen what the US election outcome is going to do to sentiment in the short term. But the important thing to recognise is that if there is an impact, a negative impact, it will only be short term on these stocks. They're trending higher very quickly for a reason. And the US election outcome will impact sentiment far more than it will impact reality. So that's it for this week. More information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.